All right. Good morning, everybody. Kind of feels like a Friday. Short week. This is the end of it, which means a long weekend. So we're going to get OpEx today. We got some jobs data and we've got a couple of auctions in the front end. We're going to be getting rate decision out of Europe, which seems to pretty much be a done deal. And we've got the president threatening Powell's job again. That's not really all that new. He's been chipping his teeth about it for a while. Mixed bag. Taking a look at what's going on, the Dow Jones is getting whacked from UNH earnings. So that's why it's not matching its peers. Small caps, less than half. S&P around a half. NASDAQ more than 3/4. This survey, the numbers are just way off, but it is just a survey. So, I never tell anybody to ignore data, but I don't think this is going to have much of an impact. Uh, saw some Fitch ratings come through this morning. They didn't seem to shake anything up. But one of the concerns that I've had is that because of the tariffs, the uncertainty, the lack of confidence, is that we end up getting a credit downgrade. And that'll move markets. So, Fitch has a Twitter or X account. Probably want to keep track of them. That way, when they come out with something. So we got the dollar in a really tight range down here. 100 and a half, 99 and a half. It's just a tight little box. Keep your eye on this to see if it comes out of the box. We don't want to see really big moves here, up or down. The current administration continues to iterate that they want a lower dollar. So we know what they want. But what they want and what the market gives them is two different things. The main thing is the rate of change, how fast it's moving. So just keep your eye on it. Whether we break above 100 and a half or break down below, looks like 99 and a quarter coming out of this range. That would be one thing, breaking the range itself. But the second piece would be how fast it's moving. We don't want to see these sort of wild rips. Got the 10-year fading back down to this previous pivot. The ES, if we match that pivot, it'd be right around in here from last Friday. And it's off of that low as well. Neither one is back to that spot. I'd continue to keep my eye on that 4.26 for the 10-year. Call it 5,200 or 5,250 on the ES. We're still looking at overnight volume above 100,000. So, we talk about a lack of liquidity, a lack of participation, big violent moves. But in the futures, we're still seeing, heavy activity. So especially in the overnight. How we end the week and how we open up next week should tell us a lot about what we're going to have going forward. Still have the put wall underneath us, zero gamma volatility trigger and call wall overhead. All the major moving averages are also now back over our head. So the 3, 10, 20, the 3-week and 10-week, even VWAP is over our head this morning. And when we look at things on the daily, we can see the downtrend is really easy to spot. Just maintaining underneath that green line, which is the 20-period moving average. And we're maintaining inside of this really big bar from April 9. So that's your control candle. And this is your resistance line or pivot point, whichever way you want to look at it. With this April 9 candle holding above the half, closing above it, not just keeping price above it, but on the day, not having a close below that midpoint. It's kind of important. If we close below it, it opens the door to go back to the bottom of it. And that's what we want to avoid. We don't want to go back to the bottom of this. Same thing on the week. Just take last week's range, 51.80, the midpoint of last week. We don't want to close below that on the week. The concern has been that if you look at the weekly, you got the 10-week here, that's the mean. And we got a little too far away, we pulled back into it. We got a little too far away and we pulled back into it. And now the concern is now that we've made our way back to it, we're just going to expand again to the downside, implying that this move isn't done yet. So that's why we continue to look for a higher high that we didn't get here. And we continue to be concerned about a lower low, which we don't want to get here. This is a false market maker move this morning. It may be real, it may not, but because of OpEx, we would never know. All right. So every time we have OpEx, we have this situation happen. There's nothing we can do about it. We know that they're trading in the front end because of OpEx and because of the roll. They could also be hedging in front of these job numbers. I really don't think they are, but on a day like this, whenever it's OpEx, you see a market maker move, you have to just chalk it up to the fact that it's OpEx. And typically, we wouldn't have elevated volume and a market maker move, right? That's another tell for us to say it's probably not a real market maker move. We still have a really wide average daily range. The base case argument is that we stay within the range and that we go into the close nice and quiet. That was the expectation for the week, is that we really wouldn't do much in front of a long weekend on a short week, that we would just try to maintain what we had already gotten, try not to give any back, and to go into the close on the weekend. And so far, we've done a pretty good job of that. 2 days really tight sideways. Then yesterday's dropped down, but still holding in the upper half of last week's range. And then today. So if we can stay inside of yesterday's range again today, just wrap this up and finish it, then we manage to keep the gains that we made last week and stay above the half. The concern is if we break below yesterday's low and we really begin to expand to the downside, and then we get through that midpoint that I was talking about and we close underneath it, next week's moves offer us an opportunity to retest these lows. That's not really what we want to see. Yesterday, we got to play with the weekly floor pivot. We found it, bounced on it, moved away from it. Now, you could look at that and say, oh, wow, that floor pivot, that was pretty awesome. I should have had that on my chart. Maybe. It was a round number. It's a big options level, 52.50. It wasn't much of a surprise that they came in and defended at a 50 level. All right. And we've had that talk before when we made this move to the downside from 6,200 all the way down. And I was laying out those 50 levels, right? In those pictures, we went through this. So it's not a surprise that they were willing to defend on a 50 level. You don't need to have something like a weekly floor pivot on your chart all the time, right? Knowing where it is on the week and just keeping track of that would have been just as good. Either way, we held above it, which still puts us in a bullish posture just because we're above the line. That doesn't help much, right? When you look at how we faded from Tuesday through Wednesday and hit it, to say something like, well, we're above the weekly pivot, so we're bullish, because that wouldn't have felt very bullish, right? But it's used in the context of how should we be approaching the market. If we're above the weekly, we should be looking for a bullish posture. And in the earlier part of the week, when we were still driving away from the weekly pivot, that made sense. But we weren't able to really expand beyond it. We've come back to it. It's the last day of the week now, and we need to hold it. Don't want to get below that. It's yesterday's low. It's the weekly floor pivot. And if we break below that, we can really expand to the downside. Today's floor pivot, lower than yesterday's, that's bearish. Price opened underneath it, and that's also bearish. We've already hit it, so we don't have an MDP today, but we did have one yesterday, and that counts for today. One of the trades with a floor pivot is to move from an R1 to an S2. I turned it on just to see if the R1 was outside of yesterday's range or not, and it is not. So we could hit the R1 without getting an inside day breakout, then make our move to the downside, break yesterday's low, get into the S1 and the S2 by the end of the day. It doesn't owe us that. If we don't hit R1, we can chop around and never hit S1 either and just stay within the zone. Really not a lot to offer from the profile. We talked about this high volume zone earlier this week and how if we move down into that, it could provide a little bit of help. It did the first time, helped us out. It's unclear whether we're going to get any more assistance if we were to go back down there again. Consider it unfinished business, and we went down there. Now we have to be concerned with, have we finished with that business, or is there still unfinished business down there? Below that area, it gets shallow, and there's really nothing that looks good from last week's pivot or last week's profile that would offer us any clues on the next stopping point. 10-day, 30-minute volume profile with TPO. We're not expecting this point of control to move anytime soon. And if it gets moved, it looks like 5,300 would be a good candidate, or 5,388. But for that to happen, we would have to go to one of those two spots and build it out higher than where it is right now. Because the candles that made the point of control where it is now are not going to be removed for at least a week. This one candle back here did not give us all that volume, right? It was, most of it was right here with a little bit of it back here. So we're not going to see these candles get wiped out. The only way this point of control is moving sooner than a week would be if we build out a new level. 5,300 or 5,392 cog line, right around in there. Could get it moved, but we'd have to go to that spot and then put in the work. We got two different distributions from yesterday. We've already tested this point of control zone. It's likely that we still have unfinished business up there. But unless we go back up today, we're never going to know it, right? It's not going to last into next week. It's really very likely only a function of this week. So if we don't go back up there today, then it's no longer going to be an issue. But we also have this other area down here, which we also continued to work on in the Globex last night. So if we have price come back down there this morning, we really want to see this level hold out. It's 5,300-ish, 5,292, that whole kind of zone. It's a part of this price action from yesterday. I would use that range as my channel and just keep it all the way across. We get into that, we could chew around, bounce around, digest. We could wick out a little bit, wick out only, and then come back in again. I think if we get below that with more than a wick out, we're very likely going to come down and test these lows, because it starts to get shallow again, right? This shallow area, then this shallow area. It's not going to give us a preview of next week because it doesn't know that today is the end of the week. One of the things that we can do is we can look at next week's expiration and look at the plus and minus on it. Next week has a 412 point top to bottom move. If we round this up, then it'd be 414. So 207 to the upside, 207 to the downside from the close right now, right where we're at. And we don't want to do it that way. It would be better after the close today, say by 4:15, everything stops moving. Whatever the number is at that point, that would be next week's range. Now, there's times where this indicator will go goofy. We see it oftentimes after we get a new contract change. It'll be something like this, really narrow, or it'll be crazy wide. And I mean like 1,000 points, big line way up here and another line way down here. So it's possible that next week we may see something goofy out of this indicator. It's just the way it is. We'll deal with it as it comes. But at this point, without having next week as a preview, we don't really have much to go on. We can see this week's range and we're still holding inside it, which is great because we've not been doing that a lot lately. 52.11 cog line on the downside. It kind of fits with the idea that we need to hold this range. But unfortunately, if we break yesterday's low, I think we're going to go for it. I think we're going to have a downside move with joy to it. And it's very likely we'll take out that weekly expected move like it isn't even there. Still, it is a line in the sand, so it's worth considering having marked on your chart for the week. If we do get a breakdown below yesterday's low, 52.11 cog line has some weight to it. There's an invisible band around the 10-period moving average on the daily of about 0.5%. And if we're within that 0.5%, we can just chop around the 10, crossing above it, below it, really without incident. We've moved outside of that band now. We're more than 0.5% below the 10. Getting below 1% would be a better benchmark. Once we're at least 1% away from the 10, we can really start to expand away from it. So that'd be something I continue to watch today. If we break down below yesterday's low, keep track of how far away from the 10-period moving average we are on the day. Four and a half percent below the 10-week, and the lines are moving back away from the 10. It's like we talked about earlier this week. Those situations where we started moving back towards the 10, and without ever getting there, we started to move away again. That's what we're getting this time too. So we've had that before, back in 2022, when it was a continuous bear market and we just continued to get negativity and we continued to make moves to the downside. So far, we don't have anything else to counteract that. So want to continue to keep your eye on the 10-week. It is our mean, so we're kind of drawn to it. It's just consider it the true average price. And so when we're this far below it, you got to think of the activities of the trades that we see, right? The big institutions, if they're selling it and we're this far underneath it, then they know that they're selling it at a discount, right? If you know something is worth 54.5, selling it at 53.25 is just a punch in the gut, right? Because you know you're selling it way too cheap. All right, looking at things that are down this morning, gold and gold miners. The miners have really been on a tear lately, 12% in 5 days. It's not much of a surprise that they're down this morning, and they're not down by much, 0.75%. It really, and that's nothing. They were due a pullback. They really needed it. They were getting a bit extended. Otherwise, the VIX is also down a bit. I think some of that had to do with its own OpEx this week. We had VIX expiration yesterday. Looking at what's up, growth, Mag 7, energy, chips, China. It's a pretty good start. If we're going to have a rally day where we could really break out and run, this would be the sectors we would want to see moving to the upside. It's not guaranteed that we're going to have a breakout and rally day, just that if we were going to have one that was built off of market breadth, this is the breadth we would want to have. It goes back to this 9 grid here. The top 3 risk on is what we would want to focus on if it's going to be a rally day. And generically speaking, tech doesn't really cover it, right? Just like finance doesn't cover it. If we wanted to open that up more, we've got cloud computing, software as a service. There's so many things that can go into quote tech. So when we're looking at what's up this morning, SMH, still a part of tech. This is a good list. And then we've got the Mag 7, the hyperscalers. And those alone have carried the market. You know, we went like over a year with just the Mag 7 doing all the heavy lifting, while the other 493 stocks dragged their feet and really didn't participate at all. So when you have those up in the pre-market, your chances of having a strong rally day go up considerably. If they can get assistance from the options world once we're open, get some really bullish 0-day push, then that would help. Maybe some help out of the yields, some headlines. But it's a good start. In the last 7 weeks, 8 weeks, we've seen a morning that started like this, that had these up in the pre-market, and it looked like a possible rally day, and then we didn't get it. Whether it was because some negative headlines came out, or we had negative options flow that day, for whatever reason, we just didn't get it. So, you know, the fact that we have it this morning is a good start, but don't put all your eggs in one basket and think that it owes us some sort of rally day today, because it doesn't. The China group is leading to the upside. All 3 of these ETFs here represent China. Then we've got uranium, and then chips, energy, tech, energy again, then the NASDAQ, and industrials, financials. Now, uranium's been tied to the whole AI data center gig for a little while, which is why it was getting overextended and it was getting heated up. Then reality came crashing back in. People started hearing 10 years, you know, to really start seeing that be viable, and it dumped back down again. So I think it's lost its data center vibe that it had, which was really screwing with things, because we were seeing it get lumped in with tech, with those data centers. And I don't think we have to worry about that getting lumped in there anymore. with these China names, be careful of headlines, right? There was some talk about a negotiator that was flying over. He was supposed to meet with a U.S. negotiator, and instead, the president said he wanted to negotiate with him in person. So then he went to the White House. They had some talks. It all sounds productive, but one simple headline could knock that right out of the water and could very easily send these to the downside again. So just be mindful of that on the intraday today. It wouldn't take more than a headline to take these China ADRs down. All right, so it should be a pretty simple day. If we want to go anywhere, we got to get out of the box. So it should be able to just very easily mark out yesterday's high, yesterday's low, only in the RTH. If we get outside of the RTH, then we can worry about the Globex, the gap close, and then whatever we left from Monday and Tuesday up there. But GTFO, we got to get out of the box first before we do anything else. And considering how wide the box is, that's our challenge on the day. GTFO, then make it work. So what I got for you guys. Enjoy the 3-day weekend. Be careful, be safe. I'll see y'all next week.